The Dow and the S&P are still rising after Trump's victory, but can the rally continue? Welcome to Market Insight. I'm Elena Casas. Wall Street has added to its post-election gains this Monday after both the Dow and the S&P 500 had their best week in more than a year. Investors are pricing in expected tax cuts and an easier regulatory environment under a second Trump administration. But with soaring tariffs in the pipeline for imports from China, there are potential headwinds for many American businesses. Well, joining me now to talk about all that is George Cipolloni, Portfolio Manager at Penn Mutual Asset Management. George, hi. Let's start perhaps with some of the upside we've seen since Trump was re-elected. In both the banking sector and tech, investors are clearly now expecting lower regulation. How much is that a safe bet for the market?
Lena, great to see you again. And you're right. So the lack of regulation, or at least the perception that there may be less regulation going forward, has been a huge boon to banks so far in financials. It's also been a huge boon to small cap stocks. And then what we're seeing is these animal spirits just start to kick in again. And we're starting to see higher valuations, and even things like Bitcoin resume their rallies. And that just peaked today at 85,000. So we are starting to see a lot of more speculation into the market. To your point, where might we see some headwinds? It might be if interest rates start to kick up. It might be at earnings periods in the future. Not right now, but maybe in the future we might see some headwinds.
Just to pick apart some of that then, for many companies, the potential impact of steep tariffs on imports, especially from China, could force them to rethink their supply chains and reduce their margins. Where could we see that impact?
So we are already seeing it. If you look at company commentary from this quarter's earnings, a lot of companies have made contingency plans. And so if you think about shoe retailers or any company that imports goods from China, they have already made plans, and they're starting to implement them. Obviously, nobody was sure who was going to win the presidency, but with the Trump win now, we've seen Steve Madden, for example, say that they're going to have to change their sourcing by about 45%, which is pretty significant. And so we're going to hear that more and more across the board because, again, nobody wants to get hit with tariffs directly, and then nobody wants to have to pass along those costs. But we are going to see, for example, non-U.S. companies really struggle with this, at least for the interim. And we're seeing that in the performance of the S&P versus all of the international indexes.
Does that mean then that this is the time to buy US-based industrials and metals companies?
That's a great point. So initially, it certainly has been. Steel stocks in the U.S., for example, have done tremendously well just in the last week or so. So I think, look, this is all speculation for right now. This is all, again, the perception that things will be a lot better for these companies. And Trump has come out very strongly. Now, what actual policy will get implemented, I think that's, again, it could be a little bit of a different story. So the thing we always gauge is, okay, look, the market's excited. How high do valuations go? And then how realistic are those valuations? And I think for us as investors, that's the most important thing to discern now. How much reality is there in these gains? How sustainable are they? And that's going to be the trick for us as investors to try to determine moving forward.
As you say, it's very soon to try and gauge the impact of some of these potential policies, but one risk that could take some of the excitement out of the market is that fear of inflation then pushing rates back up. How concerned should investors be?
Investors should be pretty concerned. So I think there's a few facets here that we need to analyze. The first one is, of course, the initial gut reaction was interest rates higher. And what we saw last fall in 2023 was that when the 10-year Treasury yield hits around 5%, the stock market doesn't like that. And the stock market fell about 10%. So we already know that the market does not like 5%. So how do we avoid that 5% move again? It's going to be tricky. I think one of the things we're going to need to hear from the Trump administration is how they're going to deal with debt and the rising interest costs that the government is paying right now. We would sure love to see some efficiency, some stability in terms of government spending, but it's really out of control right now. So we do need a kind of radical change in that regard. And I think that will kind of help soothe the market, at least the Treasury market, in terms of everyone else across the globe looking at us and saying, hey, look, they are overspending, and again, maybe not be as interested in our bonds, or maybe creating less demand for our bonds. So I think that's a huge point. interest rates are going to play a huge role from here on out. And then to your point with inflation, again, if the animal spirits kick up like they did in the late 70s, then yeah, inflation is going to be another headwind.
To your point about the federal deficit, though, economists do estimate it will move higher if Trump follows through on his policies, certainly on promised tax cuts. What could the wider fallout of that be?
You're 100% right. So everything Trump has said has indicated that, that deficit could expand. I'm not quite so sure though. If he does take such a sharp cut to spending, which he has implied he's also interested in doing, I think that could work. The last time the U.S. ran a minor surplus was in the late 90s, and they had some policy there that kind of helped rein in spending. There was one thing called pay-go, for example, which means that you couldn't spend on a new program unless you cut from an existing one. I think if he starts to look at policy like that, he really could restrain spending. And then, of course, his whole plan is to grow out of this too, which again, I think that's a little tricky too. But again, that could be one way out of it. If we do grow GDP, that would absolutely help.
George Cipolloni of Penn Mutual Asset Management, thank you so much for joining us. And that's your market insight. Don't forget, you can watch more videos on Reuters.com.